Lehman Brothers collapses. The global financial system teeters on the edge of total meltdown. Banks that seemed invincible vanish overnight. Governments scramble to prevent economic apocalypse. The world watches in horror as trillions of dollars evaporate. Everyone asks the same question: how did we not see this coming? But here's the thing. Someone did see it coming 500 years ago. Florence, Italy, 1494. The Medici Bank, the most powerful financial institution in Europe, the institution that invented modern banking, collapses, not slowly, catastrophically, taking down governments, merchants, and entire economies with it. The pattern was identical. A bank too powerful to fail. Loans to risky borrowers who couldn't repay. Political connections that became liabilities. Speculation that turned toxic. A centralized system vulnerable to cascading failures. Sound familiar? What if I told you that every major financial crisis of the modern era, 2008, the dot-com crash, the savings and loan crisis, even the warning signs flashing today, follows the exact same pattern the Medici experienced? What if the cycles of boom and bust, speculation and collapse, innovation and catastrophe that define our markets were all documented in Renaissance Florence? What if the Medici Bank wasn't just history, but prophecy? Today we're traveling back to 15th century Florence to understand 21st century finance. We're decoding the patterns that the Medici revealed, patterns that repeat with eerie precision across centuries. Because the next market crash isn't coming from nowhere, it's following a script written 500 years ago. And if you understand that script, you can see what's coming. Welcome to the most important history lesson you'll ever receive about your financial future. Let's meet the original crash prophets. Giovanni de' Medici opens a bank in Florence. Not the first bank in Europe, but different. Revolutionary. Previous banks were small, local operations. They took deposits, made loans, exchanged currencies, basic stuff. Giovanni saw bigger. He created something the world had never seen. A multinational financial network. Branch offices in Rome, Venice, Geneva, Bruges, London, Lyon, connected through standardized accounting, shared capital, and coordinated strategy. Information flowed between branches. Capital moved across borders. The Medici could orchestrate financial transactions spanning the entire European continent. This was the internet of medieval finance, a network that could move money faster than anyone else, see opportunities others missed, and dominate markets through scale and coordination. But the real innovation was deeper. The Medici perfected double-entry bookkeeping. Every transaction recorded twice, once as a debit, once as a credit. Assets always equal liabilities plus equity, the fundamental equation of modern accounting. This sounds boring. It's not. It's revolutionary. Double-entry bookkeeping creates accountability and transparency. You can track where money comes from and where it goes. You can calculate profit accurately. You can audit operations. You can prevent fraud. Before this, banking was opaque. You trusted the banker to keep accurate records, but you had no way to verify. The Medici made banking visible, measurable, rational. This enabled scale. You can't run a multinational bank on memory and trust. You need systems. The Medici built those systems. They also perfected the bill of exchange, essentially medieval letters of credit. A merchant in London could deposit money with the Medici, receive a coded document, and withdraw equivalent value in Florence. No need to transport gold across bandit-infested roads. This was revolutionary. It made long-distance trade safer and more efficient. It created liquidity where none existed before. It turned paper into money. The Medici also mastered foreign exchange. Medieval Europe had hundreds of different currencies with constantly fluctuating values. The Medici tracked exchange rates across their network and profited from arbitrage opportunities. They were doing algorithmic trading. In the 1400s, the rise to power under Cosimo de' Medici, Giovanni's son, the bank reached its peak. By 1450, the Medici Bank held more wealth than most kingdoms. They financed merchants, monarchs, and popes. They controlled the flow of capital across Europe. They weren't just a bank, they were the financial system. Cosimo understood something profound. Money is power, but power generates money. He deliberately entangled the bank with political authority. The Medici became the Pope's primary bankers. When the Catholic Church collected tithes from across Europe, that money flowed through Medici branches. When popes needed to fund wars or construction, they borrowed from the Medici. This relationship generated enormous profit but also enormous risk. A risk Cosimo managed carefully in his lifetime, but that his successors would disastrously mishandle. The Medici also financed monarchs. Kings needed money for wars, courts, and administration. Tax collection was inefficient, so they borrowed constantly. The Medici lent to the King of England, the Duke of Burgundy, various Italian city-states, and countless nobles. These loans were massive and often poorly collateralized. But here's what Cosimo understood that his successors forgot. Sovereign lending is fundamentally different from commercial lending. A merchant who can't repay loses their business and reputation. They have incentive to repay. A king who can't repay simply defaults. What are you going to do? Seize the kingdom. Cosimo managed this by staying close to power but never becoming dependent on any single political relationship. Diversification, the bedrock of risk management. His successors abandoned this wisdom, and it destroyed them. Look at the Medici Bank and you see 21st century finance. Multinational operations spanning continents. Check complex financial instruments creating liquidity. Check algorithmic trading on currency movements. Check political connections generating profit and risk. Check the Medici were doing quantitative easing before central banks existed. They were creating credit expansion before anyone understood macroeconomics. They were experiencing moral hazard before economists had a term for it. Every innovation we think is modern. Shadow banking, securitization, leverage, financial engineering has precedence in Renaissance Florence, and every crisis we think is new bank runs. Sovereign defaults, contagion, systemic risk happened to the Medici first. This isn't coincidence, it's pattern. Financial systems evolved toward complexity, leverage, and interconnection. Those characteristics create efficiency and profit. They also create fragility. Leverage, the Medici discovered this. We keep rediscovering it. Every generation thinks they've figured out how to eliminate risk. Every generation learns they've just relocated it. The question is, can we learn from their mistakes, or are we doomed to repeat them? At their peak, the Medici seemed invincible. Profits were enormous. Their network was unmatched. Their political connections were unshakable. But beneath the success, cracks were forming. The first vulnerability, relationship-based lending. Medieval banking didn't have credit scores or collateral valuations. Lending decisions were based on personal connections, reputation, and political favor. This worked when Cosimo was alive. He knew everyone personally. He understood characters. He could assess risk through intimate knowledge of borrowers. But as the bank scaled, this became impossible. Branch managers in London couldn't personally know borrowers in Naples, yet they still made lending decisions based on relationships and recommendations. The result, increasingly risky loans to increasingly questionable borrowers, all disguised by impressive family names and political titles. Sound familiar? This is exactly what caused the 2008 crisis. Banks made loans based on relationships and fee income rather than actual credit quality. They securitized those bad loans, disguising risk. When default started, the whole system collapsed. The Medici were doing the same thing, just with different instruments. The second vulnerability, political entanglement. As the Medici's political power grew, their lending decisions became political decisions. They couldn't refuse loans to allies without losing political support. They couldn't demand repayment from powerful borrowers without creating enemies. This is moral hazard. When political considerations override financial prudence, you get bad lending. When bad lending is protected by political power, it grows. Eventually, you have a system where the most powerful borrowers are the least creditworthy, and you can't fix it without triggering political crisis. We see this today in China's state-owned enterprises, drowning in bad debt but politically protected. In European banks holding worthless sovereign debt but unable to write it down. In American corporations dependent on cheap credit and government bailouts, the Medici pioneered this problem. We've just scaled it to a global level. By the mid-1400s, the Medici Bank was systemically important. Its failure would cascade through the European economy. This gave them leverage. They could take bigger risks because borrowers, partners, and even governments needed them to survive. The Medici became too big to fail. This created warped incentives. Why be conservative when risk is socialized but profit is privatized? Why worry about defaults when political power can force repayment or debt forgiveness? The Medici didn't invent this dynamic, they discovered it, and it destroyed them. Consider their relationship with Edward IV of England. The Medici lent him massive sums to finance his wars. Edward couldn't repay, but defaulting would destroy the Medici's London operations and damage their network, so they extended more credit, hoping Edward would win his wars, consolidate power, and eventually repay. Classic gambling on resurrection. Edward never fully repaid. The Medici absorbed enormous losses, but they couldn't admit it publicly without triggering bank runs. So they hid the losses in accounting, shifted capital from profitable branches to cover failing ones, and hoped the problem would resolve itself. It didn't. It got worse. This is exactly what Japanese banks did in the 1990s, what European banks did in 2010, what regional American banks did in 2023. Bad loans get rolled over, hidden and extended, until suddenly they can't be hidden anymore. The Medici also perfected political influence. They didn't just lend to politicians, they installed politicians. They manipulated elections, funded factions, and used their wealth to control Florence's government. This worked brilliantly. The Medici family produced 3 popes and multiple rulers of Florence. Their political power reinforced their financial power in a self-sustaining cycle, until it wasn't sustainable anymore. When you build a system dependent on your political influence, you're vulnerable to political change, and politics always changes. In 1494, the French invaded Italy. The Medici's political coalition collapsed. Their enemies seized control of Florence. The family was exiled. Without political protection, the bank's vulnerabilities were exposed. Borrowers defaulted openly. Partners seized assets. The network collapsed. Political power had been the Medici's greatest strength and their fatal weakness. We see this pattern everywhere today. Tech companies depend on favorable regulation. Defense contractors depend on government contracts. Banks depend on central bank support. Corporations lobby for tax advantages and subsidies. This creates efficiency while you have influence. But political winds shift. Regulations change. New administrations arrive. And suddenly, your business model is obsolete. The Medici learned this the hard way. So did Standard Oil. So did Marbell. So will today's tech monopolies and megabanks. Political power is the most profitable and most fragile form of competitive advantage. By the 1470s and 1480s, the Medici Bank was increasingly desperate for returns. Their traditional banking business, deposits, exchanges, trade, finance, had become competitive. Profits were squeezed. They needed growth. So they speculated. They financed exploration voyages with uncertain returns. They invested in mining operations based on optimistic projections. They funded wars in exchange for promises of future repayment from conquered territories. This was venture capital. In the 1400s, with similar results, most ventures failed. The exploration voyages found nothing. The mines yielded less than expected. The wars were lost or won but still unprofitable. But a few succeeded spectacularly, and those successes encouraged more speculation. This is the classic boom psychology. Early wins create confidence. Confidence fuels risk-taking. Risk-taking generates more wins initially, then the quality of opportunities declines. But by then, you're psychologically committed to the strategy. The Medici were experiencing what Hyman Minsky would later call the euphoric economy, where success breeds confidence. Confidence breeds speculation, and speculation breeds crisis. We saw this in the dot-com bubble. Early internet companies generated massive returns. Investors piled in. Money flooded into increasingly dubious ventures. Most failed. The bubble burst. We saw it again in housing. Early flippers made fortunes everyone wanted in. Banks funded increasingly risky mortgages. Prices detached from fundamentals collapse. We're seeing it now in AI, in crypto, in SPACs, in meme stocks. The pattern is eternal. The details change. The outcome doesn't. The Medici discovered this pattern. They couldn't escape it. Neither can we. But the Medici's biggest mistake was sovereign lending. Lending to kings is irresistible. The amounts are enormous. The interest rates are attractive. The borrowers seem impeccable. But sovereign debt has a fundamental problem. Enforcement is impossible. If a merchant defaults, you seize their goods. If a nobleman defaults, you claim their lands. If a king defaults, you do nothing. Because kings have armies and you don't. The Medici understood this theoretically, but they couldn't resist practically. They lent massive sums to Charles the Bold, Duke of Burgundy. He used the money to wage wars. He lost. He died in battle. His debts died with him. They lent to Edward IV of England. As mentioned, he never fully repaid. The Medici couldn't force repayment without triggering a diplomatic crisis. They lent to various Italian city-states. When those states faced fiscal crisis, they simply suspended debt payments. What could the Medici do? Invade. Each default was rationalized as unique, unfortunate, but not indicative of systemic problems. The Medici kept lending because they were trapped. They de-lent so much to these sovereigns that admitting the loans were bad would destroy the bank's solvency. So they extended more credit, hoping borrowers would recover. This is the sovereign debt trap. Once you're in deep enough, you can't get out. You can only go deeper and hope. Modern finance hasn't escaped this. Greek debt held by European banks. Japanese government bonds held by Japanese banks. US Treasury debt held by everyone. These positions are so large that writing them down would trigger systemic crises, so everyone pretends they're safe and extends more credit and hopes. The Medici did the same. It didn't end well for them. It won't end well for us either. Look at today's market and you see the Medici everywhere. Sri Lanka defaulted on its debt in 2022. Who held that debt? International banks and funds who knew it was risky but couldn't resist the yields. The Medici would understand perfectly. Venture capital has poured billions into unprofitable tech companies based on growth potential. Most will fail. A few might succeed, but the sector-wide returns will be mediocre at best. The Medici funded similar speculative ventures with similar results. Meme stocks saw retail investors pile into companies with terrible fundamentals because prices were rising. The Medici saw similar mob psychology in various commodity bubbles. Crypto projects with no underlying value attracted billions because blockchain is the future. The Medici would recognize this as speculation dressed as innovation. The patterns are identical. The scale is larger. The instruments are more complex, but the underlying dynamic speculation, sovereign risk, political entanglement, moral hazard are exactly what the Medici experienced. History doesn't repeat, but it rhymes. And right now it's rhyming perfectly with the 1480s. Lorenzo de' Medici, Lorenzo the Magnificent, dies. He'd been the family's political shield, using charisma and cunning to hold together the increasingly fragile system. His son Piero inherited the bank and the political position, but Piero lacked his father's skill. and the situation had deteriorated beyond what skill could fix. The bank's ledgers, if honestly examined, would have shown insolvency. Loans to English monarchs unrecoverable. Investments in failed ventures, worthless. Assets supporting obligations, insufficient. But the Medici had hidden these losses through accounting, creativity, capital transfers, and political pressure. As long as confidence held, the system functioned. Then the trigger, 1494. Charles VIII of France invaded Italy with 25,000 troops. Florence was directly in his path. Piero de' Medici attempted to negotiate. He made concessions that Florentines saw as cowardice. Political opponents seized the moment. Riots erupted. The Medici were expelled from Florence. Without political protection, everything unraveled simultaneously. Borrowers defaulted openly. Why repay a bank whose owners were in exile? Branch managers in foreign cities seized assets for themselves. Partners dissolved relationships. Depositors demanded their money. The Medici Bank faced a classic bank run. And like all fractional reserve banks, they couldn't meet redemption demands. They didn't have the cash. It was tied up in unrecoverable loans and illiquid investments. The bank collapsed, not gradually. Within months, the ripple effects were severe. Merchants who'd stored wealth with the Medici lost everything. Trade credit evaporated. Businesses that depended on Medici financing failed. Unemployment surged. The Florentine economy contracted sharply. Other Italian city-states, interconnected through trade and finance, felt the shock. European merchants exposed to Medici debt absorbed losses. This was a financial crisis, medieval style, but recognizable to anyone who lived through 2008. The centralization paradox. The Medici's centralized structure had enabled their rise. Coordinated strategy across branches. Efficient capital allocation. Unified decision-making, but centralization created brittleness. When the center failed, everything failed. A decentralized banking system might have seen individual banks fail while others survived. The Medici network failed as a unit. All or nothing. This is the modern dilemma. Interconnected financial systems are efficient but fragile. A shock in one location cascades everywhere. 2008 proved this. Lehman's collapse didn't just affect Lehman, it froze global credit markets. Money market funds broke the buck. Commercial paper markets seized. Letters of credit became unavailable. Global trade contracted. Why? Because modern finance is centralized through a handful of mega institutions. They're all counterparties to each other. They're all exposed to the same risks. When one fails, confidence in all of them evaporates. The Medici demonstrated this principle. We've scaled it to terrifying proportions. Consider today's supply chains. Hyper-optimized, centralized, dependent on a few critical nodes. When COVID disrupted those nodes, global commerce collapsed. Consider modern technology. Centralized cloud providers, centralized social networks, centralized payment systems. Efficient but fragile. One cyber attack or policy change can cascade globally. The Medici's collapse revealed the dark side of centralization. We haven't learned the lesson. We've doubled down on the same structure. Today's financial system faces the exact same vulnerabilities that destroyed the Medici. Political entanglement. Too big to fail banks get government bailouts. Their lending decisions are influenced by political considerations. They operate under implicit government guarantees. Moral hazard is rampant. Sovereign debt exposure. Banks hold trillions in government debt. If those governments face fiscal crisis, so do the banks. But admitting this is politically impossible. So everyone extends more credit and hopes. Relationship-based lending. Despite credit scoring algorithms, lending is still influenced by relationships. Community banks lend to local businesses they know personally. Big banks lend to corporations they've partnered with for decades. Relationship creates bias. Bias creates bad loans. Speculation. Near-zero interest rates pushed banks toward risk. They lent to unprofitable companies, funded speculative ventures, and chased yields in dangerous assets. Because traditional banking couldn't generate adequate returns. Centralization. The financial system has consolidated into a handful of global banks. They're all counterparties to each other. They're all exposed to the same risks. A shock to one threatens all. The Medici's vulnerabilities are our vulnerabilities. Their collapse pattern is our collapse pattern. The question is timing. If you know what to look for, you can see the warning signs. The same signs that preceded the Medici collapse are visible today. First, excessive leverage. When debt grows faster than income, crisis approaches. This applies to individuals, corporations, and governments. U.S. household debt is at record levels. Corporate debt has exploded. Government debt is unpayable. Student loans, auto loans, credit cards all at dangerous levels. The Medici over-leveraged, so have we. Second, political financial entanglement. When banks and governments become codependent, both become fragile. Central banks propping up markets through quantitative easing, governments bailing out banks, banks holding government debt, corporations dependent on subsidies and favorable regulation. This creates moral hazard and misallocation of capital, just like it did for the Medici. Third, speculative fever. When valuations detach from fundamentals. When narrative drives prices more than results. When everyone is chasing the same trend, danger is near. We've seen this in tech stocks, in crypto, in SPACs, in housing again. Different assets, same psychology. The Medici financed speculative ventures. We invest in speculative assets. The pattern is identical. Fourth, hidden losses. When financial institutions obscure their true condition through accounting creativity. When balance sheets don't reflect reality. When audits are perfunctory, a lapse is coming. The Medici hid their insolvency until it couldn't be hidden. Banks in 2008 hid subprime exposure until it exploded. Banks today hide commercial real estate losses, sovereign debt risk, and derivative exposure. Fifth, centralization without resilience. When the system depends on a few critical nodes. When redundancy is sacrificed for efficiency. When failure of one institution threatens all fragility is extreme. The global financial system is more centralized and interconnected than ever. This creates efficiency. It also creates systemic risk. So the critical question, are we currently experiencing a Medici-style bubble poised to burst? The evidence suggests yes. Leverage, higher than ever. Debt service consumes an increasing share of income across all sectors. Political entanglement. Central banks are trapped. They can't raise rates enough to control inflation without triggering recession. They can't lower rates without fueling speculation. Speculation, multiple asset classes are overvalued simultaneously. This rarely happens. It suggests systemic excess. Hidden losses. Commercial real estate is declining, but bank balance sheets haven't fully reflected this. Regional banks failed in 2023 because they hid duration risk. What else is hidden? Centralization. The system is as fragile as it's ever been. Supply chain disruptions, cyber attacks, political instability. Any shock could cascade. The conditions are ripe. The question is the trigger and timing. The Medici collapse was triggered by political change, French invasion, family exile. What will trigger ours? Geopolitical crisis, a major war or conflict that disrupts trade and financial flows. History shows wars often trigger financial crises. Inflation shock. If inflation remains elevated and central banks are forced to raise rates sharply, debt becomes unpayable, defaults cascade. Political instability, social unrest, regime change, policy shifts. Any major political disruption can trigger financial crisis, especially when political financial entanglement is high. Black swan event. Something unexpected and severe. Pandemic showed how quickly the system can seize. Another shock could be worse. The trigger is unknowable, but the vulnerability is obvious. We're in the late stages of a long cycle. The correction is coming. So what do you do with this knowledge? First, reduce leverage. Personal debt is the greatest individual vulnerability. The less debt you carry, the better you weather downturns. Second, diversify. Don't concentrate wealth in a single asset class or geography. The Medici were overexposed to sovereign debt and Italian politics. Diversification would have helped. Third, focus on fundamentals. In speculative times, boring fundamentals get ignored, but they determine survival during crises. Cash flow matters, profitability matters, real assets matter. Fourth, maintain liquidity. During crises, liquidity vanishes. Those with cash can buy assets at fire sale prices. Those without are forced to sell at the worst times. Fifth, understand politics. The Medici's fate was determined by political change. So is yours. Policy shifts, regulatory changes, geopolitical events, these drive markets more than earnings reports. The Medici couldn't have prevented their collapse. The structural problems were too deep. But individuals within their network who recognized the warning signs and prepared, they survived. You can't prevent the next crisis, but you can position yourself to survive it and thrive afterward. We started with a provocative claim. The Medici Bank holds the key to understanding modern financial crises. The evidence is overwhelming. Every structural vulnerability that destroyed the Medici exists today. Every behavioral pattern that preceded their collapse is visible now. Every warning sign they ignored is flashing red. This isn't mysticism, it's pattern recognition. Financial systems evolve toward complexity, leverage, centralization, and political entanglement. These characteristics create profit and efficiency. They also create fragility. The Medici pioneered modern banking. They also pioneered modern financial crisis. The cycle they experienced: innovation, growth, speculation, over-leveraging, entanglement. Collapse is the fundamental cycle of finance. We've repeated it with railroads, with radio, with housing, with tech. We're repeating it now. The question isn't whether history will repeat, it's whether you're prepared when it does. The Medici left us a blueprint, not just of how to build financial empires, but of how they fall. The patterns are there. The warning signs are visible. The question is, are you watching? The next market crash isn't some mysterious, unpredictable event. It's following a script written in Florence 500 years ago. The characters change, the setting updates, but the story remains the same. The Medici couldn't read the script because they were writing it. We have no such excuse. The lessons are there. The patterns are clear. The warnings are loud. The only question is, will we listen? Or will future historians look back at our era and marvel at how we repeated the Medici's mistakes with perfect precision, despite having their entire story as a warning? The choice is yours. The pattern is clear. The crash is coming. History doesn't repeat, but it rhymes. And right now the rhyme is deafening.